How much can an equipment finance broker actually make? The answer depends on three things: the size of the deal, how the broker is compensated, and whether the transaction actually funds. Equipment finance brokers do not lend their own money. They connect businesses with lenders and help move financing opportunities through the process. But that does not mean every application creates income. In this video, I'll explain how equipment finance brokers get paid, who may pay them, when payment usually happens, and what beginners need to understand before focusing on commission numbers. Before discussing commissions, we need to understand what the broker is actually being paid for. The broker's value is not simply sending a name to a lender. A broker may help identify a potential financing opportunity, gather the right information, organize the application, compare available lender options, and help move the transaction toward closing. That process can save the business owner time and help the lender receive a more complete application. Think of the broker as the connection point between the business that needs equipment and the lender that may be able to provide financing. The broker is not making the final approval decision. The lender decides whether the transaction fits its credit, equipment, documentation, and risk requirements. So the broker's compensation is generally connected to creating, structuring, or facilitating a transaction, not simply promising that financing will be approved. There are several ways compensation may be structured. The first is lender-paid compensation. In this arrangement, the lender pays the broker after the transaction meets the conditions set out in their agreement. That could involve the deal being documented, closed, or funded. The exact terms depend on the lender, the broker agreement, the type of transaction, and the applicable rules. The second model is customer-paid compensation. In that arrangement, the customer may pay a fee for the broker's services. That fee should be clearly explained before the customer agrees to proceed. The customer should understand what the fee is, when it is due, and whether it is refundable or payable if the transaction does not close. The third possibility is a hybrid arrangement. A broker may receive compensation from one source and also charge a separate fee under certain circumstances. That is exactly why clear communication and disclosure matter. You should never assume that one compensation model applies to every lender or every customer. Here is the question every new broker should ask before working on a transaction: who is paying me and under what agreement? The answer may be the lender, the customer, or a combination of both, depending on the structure. But compensation should never be hidden or casually explained. The customer should know enough to understand the role the broker is playing and whether the broker is receiving compensation connected to the transaction. This is not just about building trust. It is also about understanding the requirements that apply to your state, your business model, your lender agreements, and the type of financing you are arranging. So do not copy a compensation structure from another broker and assume it applies to you. Get the agreement in writing, understand the payment terms, and obtain professional guidance on the legal and compliance requirements that apply to your situation. The next issue is timing. A submitted application is not the same thing as an approved application. An approved application is not always the same thing as a completed transaction. And a completed transaction is not always the same thing as funded compensation. A simple way to think about the process is application, approval, documentation, closing, funding. Then, if all requirements are satisfied, compensation may be paid according to the agreement. This distinction is important because a deal can change or fall apart at several points. The customer could decide not to proceed. The equipment could change. The lender could request additional documentation. The transaction could fail to meet a funding condition. Or the deal could be canceled after funding, depending on the agreement. That is why experienced brokers focus on funded transactions, not just applications submitted or approvals received. Let's look at some simple examples. These are hypothetical numbers for illustration only. They are not guaranteed rates or industry standards. Imagine a $50,000 equipment transaction with a hypothetical 1% compensation amount. That would equal $500 in gross compensation. Now imagine a $100,000 transaction with a hypothetical 2% compensation amount. That would equal $2,000 in gross compensation. And a $250,000 transaction with a hypothetical 3% amount would equal $7,500 in gross compensation. The calculation itself is simple. Deal amount multiplied by the compensation percentage equals gross compensation. But the percentage, payment source, payment timing, and eligibility requirements can vary significantly. So the lesson is not to memorize one percentage. The lesson is to understand the agreement connected to each transaction. Two brokers could work on similar-sized deals and receive different compensation because they have different lender agreements, different roles, or different fee arrangements. And remember, gross compensation is not the same as personal income. That brings us to one of the most important parts of this conversation. A commission number can sound impressive until you subtract the cost of producing that deal. A brokerage may have lead generation expenses, software costs, phone expenses, advertising costs, professional services, taxes, insurance, and other operating expenses. There is also the value of your time. You may spend hours speaking with a prospect, gathering documents, communicating with lenders, correcting incomplete information, and following up on a transaction that never funds. So, if a transaction creates $2,000 in gross compensation, that does not automatically mean the broker personally earned $2,000. The actual result depends on the cost of acquiring the opportunity and the operating expenses connected to the business. This is why a sustainable brokerage needs more than large commission claims. It needs a repeatable process for finding qualified opportunities and managing them efficiently. Many new brokers ask this question: should I focus on many smaller deals, or should I chase fewer high-value transactions? There is no universal answer. Larger deals may create more gross compensation from a single transaction, but they can also involve longer sales cycles, more documentation, and more complexity. Smaller transactions may move faster, but they may require more volume to create consistent revenue. For a beginner, the better starting point is usually not chasing the biggest possible deal. It is learning how to consistently identify a real equipment need, collect complete information, communicate clearly, and move qualified opportunities through the process. Once that process becomes repeatable, you can evaluate which deal sizes and equipment categories make the most sense for your business. Compensation can vary based on several factors. The equipment category may matter. The transaction size may matter. The borrower's profile may matter. The lender program may matter. The broker's agreement may matter. And the complexity of the transaction may affect the amount of work required. This is why a responsible broker should avoid making blanket statements such as, "You will make this much on every deal." A better statement is, "Here is how this specific transaction is structured. Here is who may pay the compensation, and here are the conditions that must be satisfied." That language is more accurate and more professional. Before moving forward with a transaction, ask these 5 questions. Number 1. Who pays the broker? Number 2. How is the compensation calculated? Number 3. When is the compensation considered earned? Number 4. What happens if the transaction is canceled, changed, or reversed? And number 5. What disclosures or compliance requirements apply? If you cannot answer those questions, you may not fully understand the economics of the deal yet. And if you are working with a lender, network, or brokerage platform, review the written agreement instead of relying on a verbal explanation. If you are learning how equipment finance brokering works, subscribe to Equipment Finance Academy. This channel is focused on practical topics like finding clients, building lender relationships, reviewing financing offers, and creating a repeatable brokerage process. And if you are already working in the industry, leave a comment with the compensation question that was most confusing when you started. The biggest takeaway is this: equipment finance brokers may earn compensation by helping connect qualified businesses with lenders and moving transactions toward funding. But there is no single guaranteed commission amount. The amount can vary. The payment timing can vary. The payer can vary. And the deal may not generate compensation unless the transaction reaches the required stage. So do not build your business around a headline number. Build it around clear agreements, qualified opportunities, accurate communication, and a process you can repeat. The goal is not simply to submit more applications. The goal is to create better opportunities and help move the right transactions to a successful funding outcome. Would you rather build your brokerage around many smaller deals or fewer larger deals? And why? Leave your answer in the comments and subscribe for the next equipment finance training video.